Thank you very much indeed, and it's a pleasure to be here, and thank you for the invitation, and it's nice to see so many of you today. I've got two things to talk about today. I'm going to talk about Miton Group. I'm going to talk about how we're positioned and some of the outlook we've got going forward. But most particularly, I thought I'd start by talking about the background, about the changes in the market and how much those changes might lead to opportunities going forward. So with that in mind, we've always got the risk warning, so I'll take a few minutes to read that. But most particularly, I think the very first point to start off is that the cornerstone of all investment management is to allocate clients' capital into individual companies which put that cash to work. We've heard NWF and the ability of them to invest in their business to get a stream of cash payback, and that ultimately that value of the cash payback on that investment is worth more than the original capital. Often comes back in the form of dividends, it can be in the form of share price rises and other things. And the nightmare is that if we look in the UK, if we look internationally, overall productivity growth has been flatlining for 10 years. So although the stock markets have been great, moving to new highs in the US, the UK has been quite close to new highs recently. From the point of view of the outside, if you just look at the stock markets, it all looks absolutely plain sailing. Once you look underneath the bonnet in the engine, you find actually there's very little productivity coming through. And that is leading to a change in pattern in the markets, which we have to address going forward. So why is it that markets have done so well? Well, there's been obviously a profound change of climate in the cash flow, which has been allocated towards equities and bonds and property and such like since 2008. As you know, in 2008, the financial crisis led to a very substantial change in the level of interest rates. In the UK, we saw interest rates cut from 5.75% right the way down to half. In the whole of the Bank of England's existence since about 1690 or whenever the Bank of England started, UK interest rates had never fallen below 2% previously. So this is a period which is truly unusual. This takes, prior to this period, in spite of recessions, depressions, world wars and everything else, we'd never gone below 2%. So something really significant has changed. And since then, we've kept interest rates at very low levels. Not just in the UK, we've injected extra liquidity through quantitative easing, the buying of bonds by the Bank of England, the buying of bonds in the US and such like. And just recently, when you look at global dollar flows around the world, you've seen a surge this year in dollar flows. And that's really related to a one-off effect in the US. No quantitative easing, they've stopped quantitative easing in the US. But what's happened is when the US Fed was buying bonds, what they did was they were buying, in many cases, bonds below par value. They may have paid 80 cents in the dollar or 90 cents in the dollar. And that meant that over the following 3 or 5 years, when those bonds were redeemed at the full price, they actually took a capital profit. And before they could hit the ceiling, the budget ceiling, which they hit in September, the US Fed had to run down those reserves. So instead of issuing the normal number of US bonds to fund the US economy, we've had an unusual period when actually they issued almost no bonds in the US, and actually they've been running on their reserves. And so we've got that's led to the drain on US bonds from US bond issuance has been not there. There's been a lot of US bonds around the world, and that's meant that the dollar in value has come down. And equity markets and all asset markets around the world, including in the US, have been very buoyant. Now that's come to an end, the ceiling's been removed, so we're in a period now of slight change. But the point is, it's been an exceptional year to date. Well, that's all very well, but what about low interest rates? What is the key effect? Why is this coming through in a different way? This is something called the Wixell spread. It's a spread between the nominal growth rate in an economy, so that includes inflation, and the cost of credit, maybe a BBA type credit risk. And you can see that it zigs and zags, but most particularly, if it's above this red line, then the ability to borrow, the cost of borrowing is really quite expensive. When it's below this line, you get very, very easy credit conditions. And what you can see from this is the UK Wixell spread, is that sort of from about 2014, if anything, policy has probably been too easy. It's meant it's too easy to borrow, assets have been too easy to buy, and house prices and other assets have been going up in price. And so we've had this long period when actually the overall markets have actually probably found it too easy to actually raise capital and raise borrowings. And that leads to a misallocation of capital. Capital is not just being invested in areas which can be productive, like in NWF, but also it can be invested in all sorts of assets which are just momentum plays and all the other things. And so you've got this kind of spread where you get through the Wixford spread. This is just a model, but the most thing, it can give you an indication really of whether markets are allocating efficiently or not. And when we look at these particular trends back here, this is the US. You can see after 9/11, when interest rates in the US were reduced to 1% and held at low levels for most of the following 3 or 5 years, what you see is there was a big build-up of misallocated capital. Now, these figures can go over 100% of GDP. The total value of assets obviously exceeds 100% of GDP, but in notional terms, perhaps prior to 2007, 2008, maybe according to this particular model, you could have had 15 or 16% of allocation into assets which weren't productive. And when we got to 2008 and we saw the markets come through and we saw the invisible hand sweeping away those assets which weren't productive, what we saw is that sort of some of the condos and other things in the areas in the US got hit. What's been interesting, in fact, in the US since 2008 is actually even since 2010, probably the US has had interest rates which have been too low. And that's leading to a build-up of misallocated capital once again. If you take the Australian experience, I think it's an interesting experience because they didn't have a recession in 2008. If you remember, the Chinese stepped up infrastructure investment. So we saw in Australia quite a high misallocation of capital, maybe 25, 30% prior to 2008. There was a wobble in 2008, but it didn't come down that far. And then we've seen that period move back up to something like 40% of GDP. So a lot of misallocated capital according to this particular model in the US. But what about the UK? What do we think about the UK? What's interesting about the UK is prior to 2006, we didn't really see interest rates wildly off. As I say, interest rates before 2008 had gone up to 5 3/4. We'd already brought them up appropriately as necessary. And even since that time, with relatively low growth in the economy, aside from growth through immigration, what we've seen is actually interest rates were probably set right till about 2014. And this is suggesting now, more recently, that there's a bit of a build-up of misallocated capital in the UK. And we're talking, as you know, of interest rates coming up perhaps next month from 1/4 to 1/2. And the effect of this is that actually companies which perhaps would have struggled to survive, which may have gone bust in the past, haven't been going bust. And so when you look at international markets, this is not just the UK, this takes in European markets, US markets and other areas. What you see is there is an increasing number of companies out there which are able to survive even though they're not generating enough cash or enough profits to fund their interest bills. You might call these zombie companies. And if you look at these as a percentage of the markets, this is, all these developed markets, it was as low as, say, 5.5% back in 2006. There was a wobble in 2011, if you remember, but overall, that's moved up to something like 10.5% of the markets are in zombie companies. And these are companies which are intensely vulnerable should there be a move in interest rates or should there be a change in credit conditions. And so as investors, we've got to be very attentive. One, that there is misallocated capital out there. There is capital allocated which isn't going to generate a return. And secondly, there are a lot of companies, there's a build-up of companies which are vulnerable and could go bust at worst going forward. And yet when you look at the world in terms of measured risk, and this is looking at market volatility as a measure of the comfort level of investors, what you see is, yes, there are periods when investors have become a little bit anxious and volatility is shot up, but currently, even now, in spite of Brexit in the UK, in spite of a government which has a small majority, in spite of growth slowing in the UK economy, and indeed of interest rates potentially going up, if anything, on this particular measure, you see that actually the levels of complacency are relatively high at the moment. Investors aren't being as attentive to downside risk as you might imagine. And so there's a real danger that when things come out, which catch people out, you find that share prices actually react in a more significant way. Well, that's all very well. That's where we are now. We've got a second feature which is becoming more significant. Productivity hasn't improved by most measures over the last 8 or 10 years. And this is leading to corporate cash flow becoming more strained. You're seeing this in dividends. Dividend growth may have been good over the last 10 years, but it's often done at the expense of dividend cover. Dividend covers come down to extraordinary levels. The margin of safety is very low. But alongside that, a lot of corporate cash flow is used for wage rises. And wage rises, not in all industries, but in some industries, is actually not coming through very strongly. And as a result of that, when you ask the electorate, would you like a bit more of the same or would you like something different? Increasingly, we're seeing the electorate say, well, you know what, I might try the something different column. And that's where Trump's come from. That's one of the reasons I think Brexit was passed. And of course, the more recent election in the UK, I think if we'd given the electorate a bit longer, we might have got a different result, because I think people were changing their minds very actively just before the election. So we've got to a position now where the electorate are beginning to start looking for change in economic policies and change in political policies. Some of the politicians have been a bit caught out by this. It's quite early stages, but they're beginning to shuffle across. And when you looked at the UK election, for example, the different manifestos, we saw both the left and the right manifestos were both moving off to the left and changing policies. So we're in a period where we've had consistent economic policies for the last 30 years, the globalization of world trade, the adoption of debt, the ongoing improvement in market returns, is now being offset by change in pattern in the economic policies and the electorate attitudes. And if that is the case, then that does mean that many of the trends we've got used to in the last 30 years are going to be coming to an end, and new market trends may be coming through. And certainly what we're also seeing is that some of the policies which have perhaps led to very buoyant markets are beginning to be unwound. In the US, we've seen interest rate rises. We're seeing now quantitative tightening, QT, rather than quantitative easing, beginning to start. In the UK, there is now talk of an interest rate rise, which may happen next month. So we're beginning to see some of the patterns which have been so good for so long for equities leading to a change in pattern. And certainly we are seeing even FTSE stocks. Of course, this is an example, an easy example of a company which has come down a lot for Provident Financial, but most particularly, we are seeing share prices moving much more violently because there's a degree of complacency beforehand, because valuations have moved up with ultra low interest rates. We are seeing that actually when things go wrong, they go very wrong. And so downside risk is going to get more important. As a fund manager, we're there to make money for clients, of course, but we're also, the other half of our job is there to manage risk on the downside, and we've got to be a lot more attentive about this downside risk management going forward. The question is, where do you go if things are, if things aren't going so well, if things are going to get tough? The obvious assumption is if we are in a period where perhaps we might have weak sterling going forward, if we are in an area perhaps where interest rates might rise in the future, we might have a period of recession in the UK because Brexit may or may not go well. All of these would normally suggest to people, get into some of the international stocks, some of the bigger companies with better access to capital, better companies with perhaps overseas earnings. That would normally suggest that many of the major companies in the index probably would be the best position going forward. And yet, if you look prior to globalization, if you look prior to 1988, if you go back to the 1970s and the 1960s when the UK had a number of recessions, when we had a long period perhaps where sterling was extremely weak. In fact, if you remember in 1976, sterling was so weak we actually had to call the IMF in to actually sort us out. This was a period when the interest rates actually rose, particularly in 1974. Interest rates rose fourfold, and they weren't called a percent in those days. So you just saw an extremely hostile economy as a background. And yet, when you look at the returns, the index funds, yes, between 1955 and 1988, they made money. There wasn't a return in the markets. But the best returns didn't come from international companies with international earnings, didn't come from the companies with the best access to finance, didn't come from companies with overseas earnings necessarily. They came from smaller companies, the bottom 10%, that red line. And that was related to the fact that small companies can invest and generate productivity improvement at a time when others can't. And most particularly, what you see is the very smallest companies, the bottom 2% in this stage, the Numis 1000 index, actually generated the best returns of all. So our view is that yes, there will continue to be a position for mainstream companies. Yes, there will continue to be a position for investors in other markets around the world. But most particularly, in spite of the fact the UK might not be the best economy going forward, in spite of the weakness of sterling, in spite of interest rates going up, there are going to be more opportunities perhaps at the bottom end of the market, which is an area which is underinvested in by most institutional investors. So with that, I think I'm just going to stop talking about the background. I'm going to move on to Miton Group, so I'm going to push on now. Miton Group, it's a PLC. It's a business which is managing about 3.5 billion of assets. It's a company which I got involved in about 6 years ago. And the nature of Miton is it's a small fund management group. And as a small fund management group, let's be honest, we're up against some big competition. There's many major companies out there with good brand names, with really established reputations, opportunities with all sorts of co-agreements to get all sorts of opportunities going forward. It's a fine opportunity sector. So for most times, we can nibble away, we can take a bit of market share here and there, but most of the time, it's a real struggle to get any significant market share. Our view is that that's the pattern historically, but if there is a pattern change coming forward, perhaps some of these strategies which have done so well for many investors in the past are beginning to run out, and maybe new strategies with slightly different characteristics might be the way forward. And one of the features about the Miton Group we've set up is we've taken an existing fund management group, which is mainly in multi-asset funds. These are investing in equities and bonds and property combined. And we've set up a whole lot of new funds with strategies which have a very significant difference compared with most others. In general, most of our strategies, most of the new single strategies we've set up have a wider opportunity set. So if you take a multi-cap income fund, it invests in mid and large companies, but it also invests in small caps and AIM stocks as well. And it's that wider opportunity set, which means, one, that we've got a bigger number of opportunities to pick from. If we go off pharmaceuticals, we don't have to buy more oil stocks. But most particularly, it means that we can select companies where hopefully good and growing income is coming through, but also where the risk hopefully isn't significant on the downside. And it's this wider opportunity set which has allowed us to build a number of strategies which hopefully over time, certainly if you look in the past, have made good returns, but most particularly have done so through hopefully slightly being more careful about the historic risk. I will hand out, for those who want it at the end, a copy of the half-year report. And at the end of the half-year report, you can see a number of our strategies and how they've managed in those kind of historic records. Clearly, we're not giving advice about funds, by the way. I must be very clear about that. So we've got this opportunity set, which we've built up, which is very distinctive. It's not just hoping to outperform some of the mainstream funds. It's not hoping to keep up with some of the best performers in the market. It's actually delivering strategies which, one, hopefully can make a return, but most particularly strategies which aren't necessarily correlated with the others. And it's that complementary nature which actually gives us the opportunity of hopefully taking a significant market share in due course. So with that, what about our half-year results? Our half-year results came out in September. We're business, as mentioned earlier, 3.49 million at the August date. The average AUM was about 3.15 in the first half. That was a growth of 13%. Adjusted profits about 2.9 million. And when you look at the flows, it's been a combination of net inflows here, about 195 million of new units sold in the first half, relative to inflows relative to outflows. And then we've had, of course, markets have been relatively buoyant, and many of our funds have actually made reasonably good returns. So there's the 3.35 billion, which is the assets we were managing at the June date. It's 3.45 as of August. What you also see is a group where in the past we've made profits, but actually the profits here, I'm going to talk a little bit more about details. But most particularly, it's a very well-financed group. If you look at the end of December, it was about 21 million of cash, 68 million market cap, we heard earlier, but it's about 18.2, and I'll explain why there's a difference in a minute. This is probably a useful slide. It goes into some detail. Again, it's detailed in the half-year account. But what we see here is that actually the average margin has come down a little bit. There's a mixed change as we see some of our funds which we start up. They tend to have a lower fee rate because they give people a special fee to get to start a new fund. And some of our smaller funds have been started up in the period. But also we're open-minded going forward. As some of our funds get larger, there are opportunities to bring in very large clients with slightly lower fee deals. But most particularly what you see here is that actually the profits in the first half, which were 2.9 million, included last year a credit of £428,000, which was a one-off right back credit. And so the underlying profitability last year was about 2.7 million, and it's increased to about 2.928 this year. Last year, on the underlying profit, we made 4.7. So we made 4.7 million last year, and we made already 2.9 in the first year. So it's been a good start to the year. What you also see when you look at the income statement in some detail is that actually the adjusted profit is certainly 2.9 million, as I mentioned earlier, but most particularly a large percentage of that cash comes through in cash at the end of the year. So the cash builds up pretty strongly. And I said I'd mention the cash margin. So here we are, 21.3 million of cash at the end of last year. That's the cash coming in the first half. But what we did at this particular first half, we paid a special dividend, an ordinary dividend of £1.5 million worth, which I'll talk to in a minute. But also we bought in some shares. We issued some shares to some of our fund managers as a retention mechanism, and we offset that in the first half by buying in those shares to offset that difference. So 2.6 million of cash, and that's why it's down to 18.5 million. So overall, we've got a group here which we think is doing something different. It's not just hoping to keep up with the mainstream funds. We've got funds which are very, very widely spread compared to most others. They're able, in the past, to generate a return. These are funds which have got a historic volatility which is slightly lower than the market, and most particularly they're not correlated to the markets, and that's giving us a growing revenue in the first half. We've got the opportunity, in spite of the fact that the gross margin is coming under pressure as we scale up, the operational gearing is meaning that the net margin is continuing to increase, and so the bottom line hopefully accelerates as we grow the funds, and most particularly as we start to generate cash, as we start to generate a lot more cash. Having a strong cash balance sheet means that actually we're in a position to grow our dividends per share, and that increased very substantially last year. So thank you. With that, I'm very happy to answer any questions.
Do we buy the fund or do we buy the company? And could you give us a list of your zombie stocks? And also, what do you think about Mifid 2? Okay,
good point. Good questions. I can't possibly give you advice about whether to buy the funds or the PLC, obviously. Yes. Clearly, I mean, it's just a mathematical calculation. We can certainly give you some of the companies which might be deemed zombies. They're not. They wouldn't necessarily see themselves as zombie, of course. These are companies which are defined as companies which are generating less profit than their interest bill. And there are companies out there, unfortunately, we've seen some recently which have had profit warnings where the share prices have completely collapsed. And it's not just because they've had a one-off hit, it's absolutely because their interest bill is very substantial relative to their underlying profit. And certainly we can produce a list of companies which technically have that, and you can have a look at that. The point about Mifid is very interesting. This is a period of change, it's a period of challenge. One of the key features about Mifid 2 is that it's kind of big challenge for the industry as a whole. And so it's actually leading to a huge amount of change, not just within Fund Management Group, but also within the brokers. And as a result of that, actually, it's causing a lot of the larger companies to have a lot of complexity to deal with. We're not necessarily better than other companies in all sorts of other ways, but in terms of what we are, we're a very simple business. We're essentially a UK business selling funds which are registered in the UK to UK clients. And in comparison to many other funds, that means that in issues like Mifid 2, we can be more effective at investing and making sure that we can actually introduce these kinds of changes relatively straightforwardly in a way which is probably differentiating from many of the other major houses which have international operations and all sorts of intercompany calculations and are leading to. So whilst it will be a challenge for the industry, we don't quite know how it's all going to work out in the short term. What we do know is that hopefully over time we're in a position to take advantage of these kind of challenges because we're more agile and we're more able to deal with regulatory change and market trend change.
But following on from that question, what are you actually going to do with respect to Mifid 2 about paying for research and allocating that? And I mean, there was an increase in administration costs. Surely it's going to be a burden in terms of cost.
Yes, I mean, the key issue is there's two choices to make it entirely clear. Some houses have chosen to take it as a P&L cost. They're funding it themselves, and that's one of our options. The other option is that we continue to charge our clients. As you know, currently clients are paying for the charges for transactions, and that a part of that's access liquidity and part of that's for external research. In truth, we haven't made our decision, and so I can't give you an exact answer on that. We're looking at both sides of it. Clearly, we're a substantial group. It would be an effect if we were having to charge it to our P&L. There would be a P&L effect. But on the other hand, we're a strong group and we've got a very substantial profitability, so it doesn't alter our long-term viability as a business. But we haven't actually made the decision on that, which is why I'm unable to tell you one way or the other at this stage.
Thanks. I was just wondering, given the effect on margins that came from your newer diversification strategies in the first half, what the outlook was from the net management fee going forward, if you are going to continue with those strategies and push more for larger clients?
Yes, I mean, well, it'll be a change. I mean, there's a mix aspect. Some funds have slightly lower margins, some have slightly larger margins. So and many of the new funds don't have quite such the same margins we had previously. So there's a mix change. So as the new funds build up, then they will have a slightly lower margin. The existing margins will be diluted to some degree. And I think the pattern is as previously. In other words, perhaps the gross margin might come down a little bit, but as long as we continue to grow the business, then you will find the net margin, as in the first half, hopefully, going forward in the same way, in a similar trend.
Could I ask you a second one, just going back to the sort of economic view? You mentioned zombie companies, but do you think there's going to be a greater influence from, I suppose you could term them zombie consumers, if they're in the same position of having the problems with rates again, which obviously was something which impacted people over the last... the impact of rising interest rates again, where they can't afford the payments, mortgages being an obvious example.
Yes, I think it's a really tough environment. I'm not very buoyant about the economic outlook of the UK or indeed the world generally. I think world growth is going to be difficult. I think when you've got bond yields at ultra low levels, that does imply that long-term investment returns are going to be subnormal going forward. And so when we look at the opportunities, I think generally returns are going to be difficult to find. I think more opportunity will come. I think there will be more losers out there, companies which do get caught out by rising interest rates and having costs, margin pressure from the past. I wrote a book at the end of last year called The Retreat of Globalisation, all about ongoing margin pressure, which I think will become a feature, not so much just in the UK, of international markets. And so there's going to be companies which are going to be more losers out there, but I think actually ultimately there'll be more winners as well, because when you see big companies suffer setbacks, or even small companies which move out of market positions, that leaves more opportunity for companies to move in. And you see this opportunity for change from companies which are dying or fading out of existence and new companies coming in. You might argue, and I would argue actually, that many companies have actually been too static. They've blocked the light to some of the companies coming through, and it's an opportunity for some changing mix for some of the smaller companies and some of the larger companies which are more nimble to take advantage of that trend and actually really perform. So I think there's going to be a much wider range of individual returns on individual equities. I think there'll be a lot more companies going bust going forward. We've had very, very few companies, PLCs, going bust over the last 30 years, subnormal levels. That's partly because interest rates keep coming down, and that's come to an end. And secondly, I think there'll be many more individual companies which buck the trend, even when economic growth isn't that strong, perhaps because the consumer may be under pressure, but which take advantage of the weakness of others and actually improve their market position. And most particularly, if you do find companies going bust, if you're a PLC, you've got the support of shareholders, you've got a strong balance sheet, you can take advantage of the weakness of others to pick up those assets at hopefully the entirely wrong price, which will then lead you to have more recovery potential thereafter and enjoy extra growth going forward. So we think that there's a really big mix change going on in terms of the way that market's going to be driving, and that will attract not so much just differential in terms of performance of different stocks, but most particularly a change in behaviour where perhaps institutional investors are more willing to move away from the index, the top 350 stocks. One area where a lot of institutional weightings are very low, it's not just small companies, but particularly small micro, which investors are very underweight in, and that could lead to a revaluation of many of these companies to more normal levels of P ratios and others. So we really think that there's a major, major change coming up. It's not going to be easy. There will be setbacks along the way, but we do feel that that's the opportunity going forward.
Do you think Mifid will lead to a lot of corporate activity in the fund management industry, and do you intend to play in that?
Corporate activity, I think, will pick up. We've seen a number of fund management groups merging, particularly at the larger end, over the last 6 and 12 months, and that's continuing. And I think that's people who are perhaps finding that growth isn't there, but they can actually take out cost and lead to better shareholder returns. I think we've seen some small funds, fund management groups, which have also merged. The truth is, we don't need acquisitions. We're perfectly well positioned to grow very well. Clearly, we have made acquisitions in the past, and we may make acquisitions in the future, so I'm not going to say it's ruled out, but the main thing is we don't need acquisitions. We've got a great opportunity to grow our business, hopefully in the long term, irrespective of the need for acquisition. So the main driver is to make sure that we sell our funds well, that we deliver good performance to our clients, that we continue to keep them fully informed with all the changes in the market going forward, and that hopefully over time for us to take a small amount of market share. And that will be a big driver for returns rather than looking for acquisitions.
Yeah, how realistic is it that large institutions will start investing in small caps? When I struggle myself buying, by their standards, a tiny holding in a lot of small caps. I mean, the liquidity is so poor. How and if it barely moves their needle, if they've got £1 billion under management and they're looking to invest $500,000 or $1 million in a business, it's nothing. So how realistic is it that they're going to move into this space?
I mean, I think it's interesting when you go back to this period, right? Most institutions had a significant weighting of small micro. Why would they do that? They've got the same problems, as you say. It's illiquid, a number of searches there, they're small and fiddly, you can't buy billions in one buy and all the rest of it. Certainly secondary issues give you a chance to get invested. You can get invested for companies for long term, but actually, at this stage, although overall investment return, 76 times your money sounds like a good return in that 33-year period, when you look at it inflation adjusted, you hardly made serious money for clients. And so if you wanted to actually make proper serious money for clients, you basically had to participate in the red and the blue line. So I think that's going to happen again. I think institutions who are too linked just to index, plenty of beta around, but not enough alpha. And as a result of that, I think they're going to be obliged, actually, to participate. And those which are slow will lose clients. Those which are hopefully able to take advantage of that at an early stage will gain clients. And as a result of that, Darwin will get going, and you'll see the effect over time with institutional flows and most particularly client flows being directed to those fund managers which are participating. So they're just going to have to find a way or suffer.
Are you seeing evidence? Are you seeing any evidence of that yet?
Yes, I think we are. I mean, the very interesting thing we've seen probably in the last 3 years or 5 years is that we've seen for the first time since about 1992 the issue of micro-cap funds, institutional funds which are investing in the micro-cap area. We saw the Nano Fund, obviously, from Hargreaves Hale. We've seen recently Lion Trust have set up a unitised fund. We've set up a investment trust. There's been a couple of other investment trusts at this end of the market. Now, this first start, they're just a few swallows. It doesn't prove the trend, but it's just an indication that institutional interest at the bottom end has started to pick up. It's from a very low level. If you look at long-term institutional flows into unit trusts, they've gone up marvellously over the last 30 years, except in small micro-cap companies. If you look at small-cap unit trusts, most of them have not had much growth, or the institutional capital in that area has been withdrawn in spite of a credit boom over the last 30 years.
Hi, Jace. Just going back to productivity, it'd just be interesting to get your thoughts on a lot of the flatness has come from partly energy costs rising from the sort of, $10, $15 a barrel it was 15, 20 years ago to what it peaked at and what it's come down to now. And then also things like tech innovation seems to have been sort of stuck mainly around things like this. Yeah. And it feels like it's now moving into sort of the real industries, cars, utilising assets like homes and cars more efficiently. Do you see that sort of plateau changing as more like an inflection point going forwards, or do you still see that plateau continuing?
No, it's interesting. I mean, I think technology has been a massive driver of change in the industry, and we all continue. We have mobile phones and all sorts of things now, which are very helpful in terms of improving our productivity. And that maybe has been a feature in the past. Certainly up to 2006, productivity growth was very good. What's interesting is that really all companies are tech companies now. If you don't embrace technology as a fund management group, you're not in the business. And, so there are things about technology which actually change the dynamics. So if you look at Bloomberg software, we've got Bloomberg software throughout our business, and that makes us hopefully almost as efficient as many of the very major players out there. We can compete toe-to-toe in terms of productivity in that kind of area because of technology. What we have seen, though, is that although technology has been adopted and it's been a very exciting area, what we've got to a stage is actually when the new iPhone comes out, it doesn't really have an awful lot more than we've got already. So you don't actually need to go and buy the new iPhone. iPhone 6 is fine, iPhone 7 is perhaps a little better, iPhone 8 maybe just that tiny bit better too, but you actually don't need to. And we're seeing the number of PCs, for example, actually falling per year at the moment because people don't need to go and buy a new PC every 18 months as they did when perhaps the memory was too little or perhaps you had problems with your processor. So we're seeing a change in pattern which I think will stay with us. With regard to oil, I think we've seen a really radical change. Oil price got, as you know, to a bit over 100. We've seen the collapse of oil prices, and that has led to a sharp reduction in investment by many of the major oil companies around the world. It doesn't really make a big difference over the first 2 or 3 years, and oil prices started to pick up. There's still quite a bit of a glut out there. It's gone up to $50 or $60. Fine. But my view is if we don't get a significant pickup in oil investment over the next couple of years, we will actually start to find actually we're short of energy. And I know there's lots of battery powers and certain windmills and things coming out there which may offset it a little bit. But net, I think that could lead to oil prices actually rising to an area where it actually constrains the growth of the world economy. So I think that's another reason perhaps why world economic growth may be more modest in the next 3 to 5 years, not just down to interest rate rises, not just to quantitative easing and quantitative tightening being introduced, but also I think actually energy itself, and we all societies rely on the investment in energy and ongoing consumption of energy. I think that also may be a constraint going forward as well. So I think there's opportunities in all sorts of areas, not just in small companies, not just in companies in the UK, but even in some of the oil companies and some of the energy companies as well.